Thank you very much for joining, all of you. We had already a big day yesterday, and today it's only the beginning of the second very hard day of work. So I will begin just by a very simple question. When I launched Paris Fintech Forum 2 years and a half ago, I discussed first with this gentleman, Stéphane from AXA at the time, who was creating KAMET, and he told me, "What are you doing? No Insurtech in your event." And so I put him on main stage to explain us why Insurtech will be big. And the reality was that we did a big noise at this time to find fintech. We had only 2 candidates from Insurtech at this time. Then the year after, we did again, and we had like 10, 12. This year, we had like 100. But I must say, only 2 or 3 are really big. Most of the other ones, nobody heard the names, and they are very beginning. So the first question is, Insurtech as a subsector of fintech has received remarkable renown on matching, especially in specialized newspaper or in funding. You will present yourself every time. Okay. Look here. They know who you are. So, and if they don't, I can't help for that. So, can you react the way you want about what do you think about this buzz? Is it just Insurtech hype? Is it more than that? Do you think there is a real future for all these companies, or it's too hard because it seems to be much harder than the classical neobanks and so on in terms of capital and so on, regulation? So please, as you were speaking, you can begin if you want to answer that one.
My name is Scott Walchek. I am the founder and CEO of a company called Trov.
Scott?
We're a company called Trov. We've released on-demand insurance for single items. We enable people to turn on insurance for anything that they own, whenever they want, for whatever duration they need, and they only pay for what they use. And it's all entirely done digital on a smart device. Disruption.
Just
yeah.
KPIs. You just say figures. I mean, how much money did you raise? How much customer do you have just for?
Well, we're a private company, so we don't get to talk about how many customers we have at this date, but I can tell you about how we measure ourselves. We raised about $100 million, all VC-backed, VC and strategic, and in 4 different rounds. We've launched in Australia, the United Kingdom. We're about to launch in the United States, Japan, and Canada. We actually measure our success in a unique metric called a protected day. A protected day is a customer protecting a thing for a day or a fraction thereof. We don't even consider it a policy because, frankly, people can turn on and turn off, and we measure risk and price risk to the second, which has all kinds of interesting implications outside of just protecting the things you care about. And this year we will eclipse 1 million protected days with the goal of hitting about 3 million protected days this year. We're growing protected days. It's a great metric for us, kind of like Airbnb would measure rented nights. We kind of have that same idea. Every day we're increasing the number of protected days. We're increasing the number of protected days per customer. We're increasing the number of protected days per claim, which gives us an interesting measure of the kinds of customers that we are acquiring.
Thank you. So, hype or future for Insurtech?
Well, we think what we're doing, because it's such a unique kind of risk, actually is going to perform much better than other sectors, because on-demand, micro-duration, single item, that corpus of data that supports, or that's a new way to protect, actually has a great deal of application outside of only just protecting things. And we made a recent, quite a large announcement with Waymo, the Alphabet autonomous vehicle operating system. They're actually applying our on-demand micro-duration capability triggered by a machine to the passenger protections within the Waymo autonomous vehicle. So we think there's a great deal of upside ahead for us, maybe equal to the hype, we hope. But I think this is what we believe. We believe, frankly, that the disruption ahead is really when the platforms think WeChat in China, and think of the major Silicon Valley players who have the consumer brand, the consumer ear. We think when Silicon Valley Inc. becomes Silicon Valley Insurance Inc., that's when the disruption actually occurs. And we want to be in that middleware ecosystem.
Daniel?
Good morning.
Same thing, present yourself.
I'm the co-founder and CEO of Lemonade. Lemonade is a young insurance company domiciled in New York and spreading throughout the USA and soon internationally as well. Small team, 60-something employees, raised $180 million from Google and Sequoia and SoftBank and others. And in our first year of operation, we sold policies, homeowners and renters policies to about 100,000 Americans. I think that Insurtech is both hype and a reality. The classic hype cycle, I think you get stuff that is, in the short term, appears to be overinflated, and the old truism that in the 2-year horizon, things tend to underdeliver, in a 10-year horizon, they tend to overdeliver. But maybe I'll zoom out a little bit and share my perspective. I actually think that the insurance industry, the traditional insurance industry, is facing a sea change, and it may not be a sudden one, but I think it will be a fundamental one. The largest players in Europe and in America are the same brands that dominated the landscape a century ago. If you zoom back to the era of the horse-drawn carriage, you'll see the same names, whether it's AXA's predecessor, Allianz, 128 years old, something like that. In the US, in P&C, the average age is well over a century. Nothing wrong with being established and long-standing, but it does beg the question of whether the substrate on which those companies were built is appropriate for the decades ahead. And I think that's an existential question, a long-term question. It took Amazon 20 years to get to where it got to today, and I think you'll see something similar happening with insurance, where insurance at its core is about statistics. It's about predicting risk, which is predicated on the idea that you can get a lot of data, crunch it in a meaningful way, and predict risk. And I think that the architecture of a lot of the traditional insurance companies makes it very difficult for them to collect high quality, highly textured, and big data. Whereas operations like Scott's, where you have a constant interaction of purely digital infrastructure, means that companies like Trov and others, Lemonade, are built on a digital substrate, and then the data is of a different, several orders of magnitude more profound. So companies like Lemonade or like Trov start off with a data disadvantage because we haven't got a long history. But I think we're finding already now we're at a tipping point. Certainly in the next 18 months, I think you'll see it tip over, where the young insurtechs have more data, deeper data, more predictive data. And that goes to the very core of what insurance is about. And there are structural reasons that inhibit traditional insurance companies from implementing those same things. So we can develop the theme, but I do think that we can say today that insurance is dominated by the same names 100 years ago. I don't think our kids are going to say that sentence.
Thank you. So we just had the opinion of two direct-to-consumer actors, quite big today. Rohan, you are more behind the curtain. Your customer are the insurance. So what's your opinion about this hype future about the Insurtech model? We'll come back later about more about other questions. And first, of course, present yourself.
Hi, my name is Rohan Malhotra. I run a company called Roadzen. We are a US, China, India company, so we're in 3 of the big markets of the world. What we do is we help insurers do 3 things. We help them underwrite their current kinds of risks and newer products with better data and do it in real time. We help them process claims real time, which is one of the big challenges for them. And the third thing we help them do is provide assistance to their customers. We now work with 27 insurers all over the world. We have about 10 million customers on our platform. And we don't like to talk about the funding we've raised, but let's say we've raised from some good people who believe in our vision and who believe this is going to be a 20-year play. The question about hype or reality, I think it's not really the right question. The question is, are we solving a real problem on this stage? And we didn't start the company because we saw insurance as a sector to be disrupted. My friend had an accident on the road, and it took me 4 hours to arrange a tow truck, to get his car towed to a location, to get his insurance claim filed, and this was in Delhi. And I thought if I needed an Uber right now, it would be here in 2 minutes. If I needed pizza, it would be here in 30 minutes. And right now, I really need help. It's 1:30 a.m., and it's going to take me 4 hours to do this. So I called my partner, Raj, and I said, Raj, I think there's a substantial company to be built here. And so we don't look at hype. I think at some stage, hype matches reality. We look at the problems we are solving. And fundamentally, as Dan said, this insurance company if you were to build it today, it would be built like a technology company, not a company with an IT budget. And we are very keen on transforming insurance using data. So that's kind of the way we look at the world.
Okay, before asking you the same question to Jacques and Stéphane, just one remark. So we have two guys trying to disrupt the direct-to-consumer market and going directly in competition with our friends, and sometimes working with them, but in competition. And you are like at the gold rush, selling the tools to these insurance guys, perhaps to compete with them and to win this new competition. So what is your vision today on that? Do you think perhaps you choose a good model to be your partner to help you stay there for the next century? Or you could be afraid of these two new models that can really compete with, sorry to say, old actors like you are? Perhaps Jack, you want to answer first?
Yes. I think the three of them, they take advantage of our ineffectiveness, globally speaking. So one is clever because he thinks that we have the money to help him and to speed his growth. And the two others, they want to be the David against the Goliath, and they say, okay, we will climb the mountain, okay? But the beginning of the thing is the same story. Insurance is an attractive market in terms of growth, worldwide speaking. Attractive in some line of business, very much attractive, health insurance, for instance. Attractive in some geographical areas where growth is double digit. So from that perspective, you could say, okay, I am an entrepreneur. This field of activity looks like something where I should invest in. Then it's attractive because we are ineffective or considered as being ineffective. And because also we are, as the difference of what Amazon had, in Europe, for instance, the concentration of insurer is not exactly the same as the bookstores, okay? So the competitors will not be the same ones, just not to make the same, because within Allianz they make the same thing. But I always say, be careful, it's not the same industry. In terms of size, concentration is there. You are not bookstores of 90 billion capitalization, okay? Or selling 125 million of insurance premium. So it's a little bit different. I'm not saying that just to say there is no risk. I'm just saying you will have to make it differently. But that's just advice. Now, the thing is that at the same stage, consumer is a consumer, be it buying a book at Amazon or whatever else, or buying an insurance. So the same trends apply to our industry. And then you can take advantage of that too, okay? So I want it now, as you said, I want it personalized, and I want, of course, this industry is a data-driven industry. We are sleeping, and we have been sleeping on our data. How do we take advantage also as insurers of that? Now, is this hype or is it or not? I think for us, it's a wake-up call, okay? And if we understand that quickly, then we have our chance. We may go faster by working with one of the three right away, or by working with others, because data will be the key topic for us in the next, let's say, 2 to 3 years. But for us, it's really a wake-up call. First, also in terms of attitude, not consider because we have the size that we are protected for the future, which is not true. Size has been effective to compete with the traditional insurers. Now it's not effective anymore because it could be a handicap if we are not capable to move fast enough. Okay? We have also to change our set of mindset in terms of how do we work, how do we manage our people, how do we, let's say, read the market. Okay? So the most difficult thing for us will not be to integrate technology, will not be to work with you. The most difficult thing will be to have a cultural change. Because when you are 125 years old, you have a deep, profound culture. And that's the difficulty of the thing. To give you an example, which is not a good example, by the way. In France, for the last 3 years, Allianz France, we hired 80% of the new hires are less than 35 years old. There's still 20% because of my age, okay? So I just don't want them to say, okay, one day you are more than 35, so goodbye. But the idea is that we need to change quickly the culture. And then you need to change your population also. So for me, the question is more not to be arrogant because of what we have done over the last 125 years, to be humble, to accept that we are not doing properly the job, but to compete and to be proud that this business, which used to be a boring business, is becoming something very exciting.
If I may, just because unfortunately I'm more than 35, just to mention that these three guys too. So we can also innovate after 35.
Thank you, thank you. That's what I'm keeping telling them. But
you are only 25, okay. Stefan, your turn. So.
Yes, I would tend to agree with each of us, each of them. You know, 18 years ago, I started a business called Assurance. Some French people in the room will know what Assurance is about. It's a price comparison insurance platform, the leading one in France. And when I started it 18 years ago, I thought, well, in 3, 5, 6 years, it will, you know, market is so inefficient, prices are so different for the same risk that everybody will go and buy and so on. It grew very well. I mean, millions of whatever quotes, premium, whatever you measure. But finally, it reached a stage which was just a very, very small fraction of the total market. So we sold it. Not to AXA, not to Allianz, to Covea, another insurance group. Then I had another business, a software business for insurance companies, because I thought, well, IT at insurance is so crap that we need to build something new. And it worked, but, you know, and finally it was bought by Carlyle and a few months ago. But it took, you know, 15 years. So yeah, there is a real, let's say, I mean, there will be some kind of disruption, but it will take some time. That's my fundamental belief. And why so? I mean, for some of the reasons that I think that Jack mentioned, and I will illustrate my comment. Having sold my two businesses, then I joined AXA. So then I was part of the so-called dinosaur of the big organization to build a business, a direct business. So kind of, maybe not lemonade, but let's say a direct 2.0, not a 3.0 kind of model. And in 8 years, we built a 3 billion, you know, 7 million customers, 200 million profit, not capital raise, profit after tax. So leveraging the size, leveraging the scale, leveraging the assets, leveraging the data, leveraging the licenses, leveraging is a competitive advantage. And this is why I created KAMET, to try to ideally get the best of both worlds. So what is KAMET? So KAMET is a company which is funded by AXA, but which is completely outside of AXA, and which is working with hopefully brilliant people like these gentlemen, entrepreneurs, only seasoned entrepreneurs, who want to get the best of both worlds. So on one side, agility, you know, all of what large organizations have difficulties to, you know, to create in kind of environment, risk-taking, innovation. But on the other side, being able to really leverage the assets, the scale, the power of large organizations. And this is what I've been doing for the last 2 years. So we operate in London, Tel Aviv, and Paris. We've launched 12 different projects/companies. Some, I mean, many have died. So we tried many other things, but our model is to build so-called disruptive businesses outside of the core of AXA by leveraging some of the strengths of the big organization.
So that leads me to a question for direct-to-consumer markets, guys. As you just mentioned, having something to leverage is very important. So you go from scratch, and when you see that some big guys like Geico in the States spend over 1 billion just in customer acquisition, how do you do with just 100 million euros? Because I assume money is also not only for that. So
it's certainly the biggest challenge. In our
microphone.
Well, for us, it truly is the biggest challenge. I told you about the protected day as our sort of key metric. The unit economics of a protected day in the best worlds are very, very small. And so the cost per protected day right now is just extraordinarily high because we're building a brand in 2 continents, soon to be in the United States. That's very expensive. We came into the market believing that we had to be precious about our brand for all kinds of, we thought, very, very reasonable reasons. And now we are realizing that we need to leverage the big pools of customers and be able to offer what we do, which is quite unique in the world of protection or insurance, through other players. And I think we'll be making some of these announcements, or you'll be seeing it in the marketplaces, where we're actually partners who have a significant consumer base are actually going to co-label or private label or embed what we do into their processes, point of sale or other touch
So you mean
points.
it will be more perhaps Trov inside, that direct Trov to consumer?
Yeah, exactly right. And we'll
Toward?
yeah, exactly right. We'll actually have both. We'll have a direct-to-consumer business where we continue to innovate and continue to test our ideas, and so we can always have enough flow through the direct-to-consumer business, but also leverage these big pools. To us, it's a terrific opportunity for us to expand and to use someone else's credibility, their brand, to get to big pools of customers.
Daniel, same question.
Yeah, I think we've taken a bit of a different approach. Trov has taken a very innovative approach to the core product. So they've got a lot of education to do about micro-insurance, micro-duration. These are concepts that they've innovated and brought into the world that didn't really exist before. In Lemonade, we're selling a much more traditional product in the sense that we're selling homeowners insurance, renters insurance. People already know what it is, so we don't have to do that heavy lifting of telling people what this product is. And we are going direct, and we are competing and doing it all under our own brand. The places where we find, Geico with the $1.3 billion of spend and all the others, we find that we have certain advantages as well as obviously disadvantages. Our pockets are much less deep. But what we find is that there is tremendous ill will, even more pronounced in the US than in Europe, towards insurance companies. You mentioned David and Goliath. We find that that puts some wind in our sails. Consumers, particularly younger consumers, are disenfranchised, disenchanted with traditional insurance companies. 90% of our customers are under the age of 35. 90% of them have never bought insurance before. So we're picking the consumers off the tree kind of at the very first entry point. And what we find is that a few things are happening with Lemonade that the traditional insurance companies have a hard time replicating. One is we get tremendous word of mouth. So we see people buy insurance and they tweet about it. Usually when people go to Twitter to talk about insurance, it has expletives that you don't really want to be associated with. What we're finding is that people will tweet about it positively because they love the tech experience. They're surprised. The expectations are so low that when they have a delightful 2-minute experience, they take to Twitter to share that, oh my God, that was so cool, that was fun. I didn't expect insurance to be fun. And the second thing that we have is we have a social impact component in our business model. We give underwriting profits to nonprofits, and that also engenders a lot of goodwill, and people take to Twitter. And what that translates into is a couple of things. One is very, very high conversion rates. So Google, on AdWords on Google advertising, insurance is one of the most expensive words in the world. But if your conversion is 2, 3, 5, 10 times better than traditional insurance companies, then your costs are 5, 10 times lower, even if you're spending the same amount on the word. So people loving the product, clicking, converting will tremendously impact the unit economics of acquisition of customers, and we're the beneficiaries of that. Secondly, when they tweet about it to their friends, the marginal customer acquisition is 0 because that's seen through social media and virality. So we're actually finding that those dynamics play in a favorable way, and that our ability to acquire customers in a way that is unavailable to traditional insurance companies is working in our favor, at least at this early stage. Time will tell.
So you think you can make it with lower acquisition cost?
Well, no doubt. If things stay as they are, acquisition costs today are profitable. Our marginal customer is profitable, so absolutely.
But doubtless, it seems to be a very expensive market. I mean, 100 million, 20 euros will be just the first step, if I understand what you say about the cost of this market.
Well, this is an expensive market. It's also a market that throws off a lot of cash, right? It's a very large market. So you start generating cash flow very quickly. These are recurring revenues. The churn and attrition is very low. So once you've acquired a customer, they tend to be with you for a very long time. And then the next year, the money comes in with no marginal cost of acquisition. So actually, the unit economics and the long-term economics of the business look pretty rosy. Time will tell, the best laid plans and all of that, but
my understanding is you choose a very different way. Which microphone is below something? You choose a very different way, Daniel, to do your business than Scott, because you are doing the underwriting. Yes. So, Scott, you are working with, I think, AXA, is that?
AXA, Suncorp, Munich Re around the world,
So,
yeah.
so you find a good partner, and then you design your innovative offers, but they are behind. So you choose perhaps what I may find like a more harder way to do your underwriting. What are the plus and minuses of this strategy?
Yeah, and Scott and I were just talking about it in the room before the session, and it'd be interesting to hear his perspective. We thought we're choosing the harder way, and I'll explain why we chose the harder way. In retrospect, I'm not sure it was the harder way. Sometimes the harder way is the easier way in retrospect. Because we control the full stack, we're vertically integrated. We work directly with underwriters, our own underwriters. We write our own policies. We handle our own claims, and we work directly with the regulators. And without the dependence on a very large company that may have very different priorities, that gives us freedom to move pretty quickly. So things have moved faster than we anticipated. We got licensed in New York 15 months ago. We've since received 27 licenses in different states throughout America. We now offer our product to over 40% of the US population. So that was much faster than we'd anticipated. But the reason that we did it is that in our telling, the root cause of the animosity that people feel towards insurance is baked into the business model. The basic business model of insurance means that when I decline your claim, I get to pocket that difference. And we've studied this at length. For the last 700 years at least, there's a recorded history of people hating their insurance companies, and it's persistent across continents and across centuries. And if I oversimplify, I'd say it's down to this conflict of interest, or at least perceived conflict of interest between the consumer and the insurance company. By the way, much of it undeserved. Insurance companies operate much better than people credit them with operating, but that is the perception, and it's persisted for centuries. And in our telling, you cannot build a lovable brand with high conversion rates, with high virality, on top of that kind of perception of a conflict of interest. If there's that conflict of interest, it will manifest itself, and it will be very difficult to build a lovable brand on top of it. So we wanted to change the fundamental business model of insurance, and that's what we did. And to do that, you can't just partner with an existing 100-year-old company. You really have to start from scratch, because the business model that we adopted or created didn't exist. So Lemonade takes a flat fee. This is really a page out of Silicon Valley's play. Scott spoke about Silicon Valley Insurance Inc. In Silicon Valley, a flat fee is a very normal way of thinking about things, but it isn't in insurance. So you pay us 1,000 euros. We take 200 of those euros for ourselves. We'll never take more, never take less. We use the other 800 to pay claims and buy reinsurance. If there's money left over, it goes to charity. If there's insufficient money, reinsurers pay it, not us. We've insulated ourselves. That means that I'm never in conflict with you, my customer, at least not at first, in a first order kind of conflict. And it's a very different business model, very different approach. It has social impact baked into the very core of the business model. And to do that, we had to start from scratch. We were not believers in the notion that you can sprinkle technology, pixie dust style, on top of a 100-year-old edifice and affect profound change. If you are a 100-year-old company, it's the right thing to do, but we weren't. We had the benefit of being legacy-free and starting from scratch and asking ourselves the question, do we want to sell tools to the insurance companies, or do we think we're better off starting something entirely from scratch?
Scott, the opposite question. You did the opposite choice.
So to be frank, we didn't know any better. When we started off, we had a supposition that the emerging generation who's living their life on the supercomputer in their pocket had four kind of key ways that they're changing in their consumption of goods and services. It had to be on demand, micro duration, don't lock me in. It had to be, we said, unbundled, like what iTunes did to the record album, we were going to do to the contents coverage, and it had to be people optional. They want to engage with technology rather than with a human, or at least have that option to engage with a human if they want to. To do that, we felt like we had to concentrate a lot on the human engagement side. The app has a great deal of love. People love using Trov today. And we didn't know what we had to do on the backside. We've learned. We call ourselves capacity agnostic. We work with insurers like AXA and Suncorp and Munich Re around the world. Sampo in Japan will come out later this year. And they plug in their balance sheet. They want to put their risk closer to this new consumer, this new generation. They have they feel existential risk looking ahead at this new generation, and Trov gives them a front row seat, if you would, to that next generation. What we learned is that it's not really easy. And in some ways, we admire what Dan has done, because controlling that user experience, we went in thinking, and you've remembered this pitch a long time ago, we're a tech company, ellipsis, offering insurance. But really, we are insurance tech, and we've had to figure out over the last 2 years, essentially, that there's as much engineering in the technology for engaging consumers and keeping them as there is in the underlying insurance product. Watch. In the United States, now that we've grown up a little bit, we know better. In the United States, we're an MGA, so we have a much greater control over the outcome, the claims handling and such, without a lot of the burdens of also becoming a regulated insurer. We've been approved with the following. So we're offering this new policy underlying. So we go to a regulator, we have this conversation. Our policy that we want you to approve of is on-demand, micro-duration. We track risk to the second. People can turn it on and off anytime they want. And it's on-demand and single item for every kind of single little item, whether it be a watch or a piece of jewelry or what have you. And that blows your mind away. Then we say it's loss, damage, theft. It's global. It's also works as a warranty. And finally, it's price adjusting, which means that every month of the value of the items, we track the values of the items every month, retail replacement value. As it goes down, your premium will change that following month because on a monthly billing cycle. They don't know what to do with that. And but the point about all that is, we've learned much more. We think we still can be capacity agnostic and plugging in people's balance sheet, but we have to take a greater degree of regulatory stature.
Stefan, you are launching your own Insurtech every 1 or 2 months, I assume, because you have some failure, some success. I assume you ask yourself the same question when you want to launch a new project. What's your point of view about these two strategies in the world market that you know very well?
Well, fundamentally, I believe that the B2C approach is pretty challenging. So it doesn't mean that some players will not eventually succeed, but I mean, as you mentioned, it's not because you have a nice model that you will make money. You need to collect more than what you pay. Acquisition costs are a real topic. And I heard you, if I understand well, you pivoted a bit from a B2C initially to a B2B, more enabling other players. Probably because acquisition costs, even if your value proposition is great, it's probably because you had difficulties to find a way to make money. And ultimately, le juge de paix is, are you building a model which, at least at some point in time, is able to generate money? And I believe some will. I don't know which one. If I knew, I would be richer. But some will definitely. But I think the fundamental difference, especially with the more fintech kind of environment, is that very, very few models today in the world which have proven to tick the bar, to tick the. So we'll see. And I think we all need, either startups, incumbents, people like us to be humble, to test, to learn, to pivot when needed. I have, I know some models will emerge. Which one? We'll see.
Oh, and we just heard that Scott began with B2C, and now he's doing also B2B2C, good source of revenue also, not only for new markets. And that's quite a big trend in fintech, by the way. 90% of them are now selling to banks and insurance because they have the money, a bit more than the end consumers. You began directly by that way. Any will perhaps later one day to say, okay, now we have 100 million customer database, let's do B2C?
Our thesis about the world we all live in is that insurance and financial services will be built on 3 layers. It's technology, distribution, and balance sheet. So we're very happy to partner with people who have a great balance sheet. We are very happy to figure out distribution ourselves. So for example, we now do 2 million ride-sharing insurances in India, which is probably one of the largest ride-sharing insurance for Ola. So what we did was we built the technology that goes into the driver app, the customer app, and we protect the customer. As a part of this, we acquired AXA's assistance business in India, because when you're giving ride-sharing insurance, you want the customer to get roadside assistance.
So you bought the business of AXA. It's not AXA buying your business. So it's a good way around.
We have a great partnership with the AXA group. We feel like they understand our vision, that this world needs to be transformed with data. We are working with them in China now. One of the key things that we learned by being in India and China, these are truly mobile-first economies. And the big thing is happening there that people may not buy cars anymore. People may not, and this kind of embedded insurance is something that has really been pioneered in China, where you can protect your e-commerce shopping cart, you can protect your ride, you can protect micro-insurance on travel, etc. So this kind of view into the world that the world doesn't solely exist in the silos of life, auto, health, travel, and medical is fundamental to the way we look at things. Is we are looking at building new products. We are happy to partner with the existing guys to build these products. We can be the technology, we can figure out the distribution and help them underwrite newer kinds of risk. And if our partners believe in us, I think that's a win for everybody across the table. What we are not very good at is what Lemonade has done, is to build a brand. So that's something that we work with Allianz, we work with AXA, we work with AIG, so we work with 27 global insurers today to help them recreate their insurance experience and possibly offer a better customer experience to their customers. So our vision of the world is to solve the problem. It doesn't matter who takes the cake on that. So.
Jacques, we just heard that AXA did a choice with Roadzen, but perhaps with others also, to externalize a bit of their activity. That is fine, perhaps Roadzen will manage differently, better, with more technology. Is Allianz doing the same kind of choices in some geographies, or same kind of thinking for this kind of business?
I am not aware of that, and I am the guy in France only, as you know.
Are you doing it for France? Are you thinking about
no,
working with some other people?
I think we, because you mentioned travel insurance, we are worldwide the #1 in travel insurance. We invest a lot in technology in order to embed this tiny insurance into everywhere. I mean, your credit card, your plane ticket, wherever we can. So I would imagine that we work a lot in terms of how do we collaborate? How do we develop our business, your business, and our businesses? How do you speed up our market share by bringing us technologies that we do not want to invest into, or because we realize that we are far away and it's too late for us to regain momentum, okay? And on some, but for us, what has changed the last 5 years is that we were looking every morning what AXA and the others were doing, okay? Now, I look every morning what they are doing. And it's more exciting, by the way, but no, and more interesting. And to come back to your point, I think, yeah, but beware, we change. I take Allianz France. In the next 2 years, our 9 million contracts for individuals, be it household, be it small professionals, be it motor care, we will be capable to rewrite them and reprice them anytime. Okay, so just keep that in mind. We are slow movers, but we move. And sometimes we move with the help of you, some of you, just to speed the thing up. And I think in the data field, we will use a lot of external providers and new entrants in the Insurtech field. So every type of collaboration will be possible. Either we sell and we collaborate, either we just collaborate, or we invest and we collaborate. Okay, so I think we are very open in terms of what type of collaboration, what will be the future. There is no precise law, which is good. And then it's just a question of opportunity and time to market. And also, it's also a question of willingness to change quickly. Okay, and so I still believe that it's not because you are humble and you recognize that you have weaknesses that does not mean that you do nothing. Okay.
Well, by the way, you already did it 10 years ago with another business. With Allianz Bank, you worked with a fintech of the time, which was Pro Capital, and you did exactly what AXA did with Roadzen.
We just externalized all the back office and middle office, and now we kept only the front office, and it's a zero-risk bank now, by the way.
For you.
No, but because we consider that we are a regulated business, we need a lot of capital. We could not afford also to take risk on another
So you can do it again. I mean, you did it for one business.
We could do it again. And,
Stéphane wanted to react.
No, but just to elaborate on what Jacques said, I think the answer for the large organization like Allianz or AXA is to be very pragmatic. Yep. You know, either to partner, and AXA is partnering with you. I mean, in the UK, is partnering with you in India. AXA is investing. AXA has a large investment fund called AXA Strategic Venture, and I think that François Robinet is in this room. It's a multi-hundred million, set of funds investing every week in different, innovative businesses. AXA is also now building things, not internally, because building internally in the legacy is difficult. So this is what I'm trying to do, for AXA, outside of AXA, with entrepreneurs. AXA sometimes is providing capacity, is providing expertise. Sometimes it may even decide to partner or exit, businesses with people who are doing it better than what AXA does. So I think the answer is to be pragmatic, and I believe the key is to know what added value you are bringing to the table. So whether you are a giant, whether you are a very small company, you need to be absolutely crystal clear on what you are bringing to the market. If you are not crystal clear, it will be more difficult, whether it's for AXA, whether it's for a new startup.
My last question, we have only 4 minutes, so my last question to all of you will be more about geographies. When I hear the three of you and when I read a bit the biography of your companies, I'm struck by something. So the two of you launch in established countries, mature market, but innovative solution in mature markets. And Rohan chose to be mainly first in what we call for long emerging market. I'm not anymore sure we can call India and China emerging market. They can buy all of us like that. So I mean, are they really emerging market? The reality is when you go there, and I go a lot in those countries to find and to build this event, they are all on mobile. They are exactly as you mentioned, 85% are below 35 years old, but it's this population, not the people in your company. So they are all digital native and they are used to. Don't you think perhaps you choose the hard way, going in the already very competitive market, very consolidated market you just mentioned, and this is for you guys. Do you think you can have the same success in established market like the United States, because you say you want to develop also there? Do you think you can have the same success you have in perhaps easier markets that are all growing so fast now? And perhaps for the established guy we have here, where is the growth tomorrow for you? I mean, when we see this already consolidated, very conservative market we have in Europe, compared to this market, when you put €1, you have 10. So you have 4 minutes, even if we are a bit late. All of you to give an answer. Perhaps Rohan, you begin, and we do like that.
As you said, I don't think China or India is an emerging market anymore. They are the mobile-first economies. People there are now buying insurance for the first time. India has a demographic where 50% of people are under 25, right? Which is the youngest demographic the world has ever seen in a single country. And they are not really concerned about buying health insurance. They don't think they're going to get sick. They are not concerned about buying life insurance. But if you can embed insurance into a product they use and love, and then they get educated. Right now, India, China, it's about 1 to 2% of GDP goes into insurance. In mature markets, it's about 5%. So these economies are going to grow, and they're growing at a tremendous rate. Paucity of time, but the biggest Insurtech platform in the world is a $15 billion company called Zhong'an, which is, as per our thesis, it's like technology distribution balance sheet. It's a JV between Alibaba, Tencent, and Ping An, right? So you're seeing 3 of these giants collaborate to create value, and they did it on 2 or 3 specific products in the world. So they introduced a new product for travel delay or e-commerce insurance, and they were able to create value. So I think more than market, we look at value. We have a completely global vision for this, and insurance works on the language of data. So we are not concerned about whether it's Chinese or Hindi or the US or any other market. If we can build the right data models, I think it can be successful anywhere in the world.
So we started in the US, we're expanding globally this year, but we love the US, and I love established markets, because I'd much rather compete with a State Farm or an Allstate or any of the companies with the name farm or state in them than a Zhong'an or Ping An. So the companies that are digital first in China are formidable companies that have already learned the lessons that their Western counterparts have not yet internalized. And they're legacy free. They're not carrying 100 years of legacy and 60,000 agents with them.
So if I hear you, you are the emerging digital market, the States.
That's right. That's right. So I think coming to a place where established players have the disadvantages of the 100 years of legacy and the 50-year-old computer systems and the 50,000 network brokers, broker network, that to us is more interesting and more of an opportunity than some of the emerging markets.
So one of our core values actually has been to build in the capability to open new territories relatively quickly and quite effectively. So we are in Australia, then 6 months later we open in United Kingdom, then we're about to open in 50 new countries, 50 states in the United States, each with their own regulatory authority. Same sort of, the tech has to, though, address all of them. And then Canada and Japan are in our roadmap this year as well. And so we actually think that there is no emerging market for us. We think that all markets, I think it was well said that it's really the core of it is the data. We capture all the data. We have the enterprise play across all marketplaces, and we think that that is to a great advantage, and we look forward to expanding more rapidly.
Thank you.
Well, I think if we talk about Allianz, globally speaking, we may have one area, which is the one where you operate currently, where the way of growing will be different from the traditional ones, and we may partner with banks, we may partner with all the names you just mentioned, and we may partner with you, okay? On markets like the French market, which are growing at 1.5%, 2%, it's a totally different topic. So the way I view it is that if we move faster than the traditional ones, I mean mutuals and the others, we can grab a little bit more. But what we need to do quickly is to understand what are the new trends. So to be really the first one on usage-based, on demand, on collaborative insurance, all those new trends where there is the future of growth, because mobility will be different from what it was and used to be up to today in 5 to 10 years. Same thing for what will be the future of smart cities and things like that. So we view new risk rising from this digital network, and we have to be the first one to grab them, because in that case, in insurance, the first one will be the winner.
Thank you. Nothing for you? So we finished. Thank you very much. All of you, you can applause.